afternoon again. Tweedy Browne is the wrap-up session for what's been an incredibly interesting and rewarding conference. And we're going to do our absolute best to make these closing sessions as interesting as we possibly can. We realize we're the only thing standing between you and the cocktail hour. So let's get with it. We were asked to speak at last year's conference, which had to be postponed, as you know, due to COVID. At that time, a suggestion was made that we should perhaps reflect on Tweedy's long and successful tenure in the value investing business and possibly share some important lessons learned over the years. After all, last year was Tweedy Browne's 100th birthday. If we may be so immodest, surviving intact for 100 years is quite a feat for an investment organization, particularly in this day and age. The firm's longevity is largely a tribute to the efficacy of Benjamin Graham's framework for investing and a healthy dollop of good luck. So for the next 25 to 30 minutes, I'd like to bring the focus of the conference back to Ben Graham and a little Tweedy Browne history. For the history of our little firm really spans the history of value investing. And if we have time, I'll conclude with a few simple lessons learned during our century of serving investors. When Forrest Burchard, aka Bill Tweedy, was setting up his investment operation in 1920, he was looking for a niche in the securities business where it would face very little competition, and he fell upon the idea of making markets in inactively traded, closely held securities. These were companies that were often largely illiquid, but did have some publicly traded equity. He'd run around New York to the annual meetings of these companies, copying down the shareholder lists, which you could do in those days without a phalanx of lawyers sitting down upon you, and then send out postcards to the shareholders, offering to provide liquidity in their shares. If you needed liquidity in your shares, you couldn't get it at your local brokerage, but you could at Tweedy & Company. And by almost any definition of value, when these shares did trade, they traded at highly inefficient prices. John Train would later, in his classic The Money Masters, refer to Tweedy Browne as the pawnbroker of Wall Street, providing much-needed liquidity for desperate sellers at almost criminally low prices. In those early years, at any given point in time, the firm would have hundreds of bids, what they referred to as hooks in the water, if you will, on the stocks in which it was interested, and would simply wait for the fish to bite at their price. Tweedy & Company's market-making activities soon attracted the attention of a young securities analyst who was scouring the markets for bargains. His name was Benjamin Graham. And it's fair to say that after making Graham's acquaintance, life would never quite be the same for the young pawnbrokers at Tweedy Browne. Graham had founded his own firm, the Graham-Newman Corporation, in 1926, not too many years after Tweedy & Company had opened its doors to investors. A brokerage relationship grew up between Graham and Tweedy Browne, later to become Tweedy, Browne & Riley when Howard Browne and Joe Riley joined the firm. Graham did not mind the illiquidity in the shares. Price drove his interest, and diversification muted his risk. In the early 1940s, Tweedy Browne even moved its offices into the same building as Graham at 52 Wall Street, where it seemed smart to be near your best client. Furthermore, you didn't have to go out in the rain when settling up trades with Graham. In 1955, the partners of Tweedy, Browne & Riley made another very fortuitous acquaintance when they offered desk space to a young Graham-Newman analyst named Walter Schloss, who had left Graham's employ to set up his own investment partnership. Walter was first lodged between the front door and the water cooler at Tweedy Browne. If someone wanted a drink of water, Walter had to scrunch up against his desk, barely able to breathe, so the one with the thirst could get by. Walter shared office spaces with Tweedy Browne for the remainder of his illustrious career, retiring in 2003 at the age of 83, having put together a remarkable 48-year record for his investors. In addition to being a source of wisdom and good humor at Tweedy, Walter introduced Howard Browne to two friends whom he had worked closely with while at Graham Newman. That was Warren Buffett and Tom Knapp. In 1956, Graham decided to retire. He offered his business to his star analyst, Warren Buffett, but Buffett decided to move back to Omaha, Nebraska at his wife's urging and founded the Buffett Partnership. At the behest of Howard Browne, Tom Knapp, the other Graham analyst, joined Tweedy Browne and was instrumental in spearheading the firm's transition into asset management and the establishment of the firm's first investment portfolio, which initially consisted of only the partner's capital. Tom viewed Tweedy, Browne, and Riley as having a wonderful repository of undervalued stocks. He didn't want to simply make markets in these securities, as he had seen Graham make lots of money investing in them. Perhaps because of his days under Graham's tutelage, Tom was always a bargain hunter. Rumor has it that he would check the turnstile before depositing his subway tokens to see if he could get a free ride. In 1958, Tom and Warren Buffett set out to corner the market in the newly out-of-print 4-cent American Blue Eagle airmail stamp. Contacting post offices all over the country, they spent roughly $25,000 to acquire more than 600,000 stamps. Unfortunately, it turned out to be a boondoggle because at the end of the day, there were many more stamps than collectors. Needless to say, Warren and Tom, for a number of years, didn't have to look to the postal meter for postage. In 1968, a new partner, Ed Anderson, joined Tweedy Browne to take the seat of the retiring Joe Riley. Ed was a trained scientist, having received a PhD in chemistry, and he worked at the Atomic Energy Commission. While at the commission and after devouring a copy of Benjamin Graham's security analysis, Ed began investing his own and a number of his fellow scientists' capital, utilizing Graham's value methodology. As a scientist, Ed applied an intense analytical zeal to whatever field he explored, and investing was no exception. He believed in gathering all the data before making decisions, which may help to explain his conclusion that Graham's approach worked best. Ed developed a true passion for value investing. He set up an investment partnership, left the Atomic Energy Commission, and went to work alongside a young business lawyer out in Los Angeles by the name of Charles Munger. While an analyst at Wheeler Munger, Ed got to know Charlie's friend Warren, married Susan Buffett's college roommate, and continued to manage his investment partnership. In 1968, Ed accepted an invitation to join Tweedy Browne as a partner, and he brought his investors with him. Hence, Ed's original band of friends and scientists became Tweedy Browne's first outside investment clients. At the time of Ed's arrival, the Tweedy partners had thought about shortening the firm's name to Tweedy Browne, because that's how they answered the phone. However, the firm's bookkeeper had assumed Tom Knapp would replace Joe Riley on the letterhead, since Tom had been with the firm for 11 years. The new stationery that he had ordered arrived with Tweedy Browne and Knapp on it, and the partners had to decide whether to throw it away and order new stationery or simply change the firm's name to Tweedy Browne and Knapp. True to their value heritage, the latter course was chosen. Howard Browne tended to trading at brokerage at Tweedy Browne and Knapp, and in the 1960s, acting as Warren Buffett's broker, he purchased virtually every share of Berkshire Hathaway that Warren Buffett owns today, executing his first purchases in 1962 for approximately $7.50 a share. Apparently, Howard's reputation for being closed-mouthed appealed to Warren, as discretion was of the utmost importance when he was acquiring shares. When Warren came to New York on business, he could often be found at the Tweedy Browne trading desk. Responding to the American economy's evolution in the 60s, 70s, and 80s, away from its traditional post-war industrial base to a more service-based economy, Warren Buffett took Ben Graham's approach a step further and discovered intrinsic value in intangible assets such as earnings power associated with a company's brands, its customer loyalty, the capital allocation record of its management, and the economic moats created by durable and sustainable competitive advantages. Buffett was also greatly influenced by Munger's interest in better businesses and increasingly turned his attention to higher quality businesses with strong competitive moats. And he took concentrated positions in these companies, paying what he felt to be reasonable prices for reasonably assured future compounding. This was a far cry from the more statistically driven approach he learned from Browne and utilized so effectively in his early investing days with the Buffett partnership. Today, as you all know, Buffett has even gone so far as to invest in technology, a segment of the market that he had sworn off in his early years because of high rates of change and fears of rapid obsolescence. As of December 31 of this past year, Buffett's $120 billion position in Apple constituted over 42% of his overall investment portfolio and was his largest public security position by nearly a factor of 4. Throughout the 60s and 70s, the investment account at Tweedy Browne grew steadily alongside its market-making business and consisted largely of Ben Graham net nets, a collection of inactive stocks, and a smattering of hidden asset situations. By the mid-1980s, the firm's price-sensitive approach had produced such notable investment results that Warren Buffett referenced both Tom Knapp and the firm in his legendary speech at the Columbia University Business School in 1984, entitled The Super Investors of Graham and Doddsville. The changing economic and investment landscape during this period was also not lost on Tweedy Browne. Value investing was slowly beginning to gain traction, and with an ever-expanding professional investor class, net current asset stocks and statistically based quantitative discounts were getting harder to uncover. A new generation of partners would also begin to emerge in the 70s and 80s, including Howard Browne's two sons, Chris and Will, who together with John Spears and Jim Clark would capitalize on the firm's laudable investment record to build a successful asset management business which thrives to this very day. A number of LBO titans also emerged on the investment scene in the late 70s and 80s, who would help to fuel a takeover boom financed by declining interest rates and Michael Milken's junk bonds. John Spears, who's with us today, had joined the firm in 1974 and established quite a profitable business at brokering takeover ideas to these acquisition-minded investors. Several of these titans became clients, including investors such as Ron Perelman, Arthur Cohen, Bill Simon and Ray Chambers, and the partners of Dyson, Kistner, and Moran. The firm's collaboration with these buyout professionals had an important impact on Tweedy's investment process, as acquirers' multiples and merger and acquisition comps began to inform the firm's evolving approach. This evolution was further reinforced by the addition of Jim Clark, who brought private equity experience to the firm in 1976. Jim's insight regarding the valuation of low capital intensive, earnings-based businesses marked a subtle but meaningful turning point in Tweedy Browne's investment process. No longer was the firm dependent solely on statistically based paint-by-the-numbers methodology. The arrow of business appraisal and study of acquisition comps had been added to its quiver. Utilizing this new earnings-based valuation framework, the firm went on to make other investments in news and broadcasting companies, and in the mid-1980s, Tweedy Browne also discovered the acquisition pricing model for food companies and other branded consumer products companies. By incorporating into its investment process the ability to make business appraisals, utilizing an earnings-based valuation model, the firm had clearly expanded its potential opportunity set of cheap stocks. With globalization on the march and valuations on the rise in the United States in the 80s and 90s, and we might also add with the encouragement from a small cadre of Swiss clients, Will Browne led an initiative to take Tweedy Browne's investment approach abroad into non-US equity markets. After the firm's white paper, What Has Worked in Investing, revealed that empirically the Graham approach had worked as well or better outside the United States, the firm began to aggressively invest in non-US equities. The next generation of partners at Tweedy would help to expand on this idea. And today, approximately 70% of Tweedy Browne's client assets are invested outside the United States, where equity cultures are somewhat less developed and valuations far more enticing. While the framework for investing, this Tweedy Browne framework, has remained inviolate over the years, the firm's approach to investing has clearly evolved from its early focus on quantitative cheapness to a later emphasis on comprehensive business appraisals, which valued both tangible and intangible assets and earnings power. The early adoption of the use of enterprise multiples and valuation coincided with the change in the economy, from one that was tangible asset heavy to an economy dominated by asset-light, service-oriented enterprises with growing earnings power. Adapting to the realities of this new opportunity set for investing, the firm today spends a considerable amount of time studying the qualitative drivers of businesses, what Munger has often referred to as the hard-to-measure stuff. And this stuff is often determinative, particularly in the analysis of earnings sustainability and growth. Tweedy's geographic horizons have also continued to expand over the years, and today include not only the developed markets, but the more developed of the emerging markets, including China. Applying this investment banker's appraisal approach to valuation, the Tweedy partners today manage just over $12.5 billion, including over $1.3 billion of their own capital, and that of retired partners, employees, and their families. They're willing to own just about anything at a price, at a discounted price. And that means cigar butts when we can find them, average businesses, above average businesses with durable competitive advantages, and even technology stocks when we get those rare pricing opportunities. Ultimately, Tweedy Browne's 100-year history is a study in resilience, durability, continuous improvement, and steadfast commitment to a set of enduring principles that have proven validity. But at the center of it all has been an abiding commitment to intellectual honesty and fair dealing with clients. For as Howard Browne once said, your clients will forgive you for your mistakes, but they will never forgive your dishonesty. And that's as true today as it was back in the day. Before addressing a few of the lessons learned from our years of service to value investors, I thought I'd make just a few observations about what's been an unusually challenging time for value investors. While it's perfectly normal for value stocks to periodically underperform, this recent dry spell for value has been uncomfortably longer than most. And it's causing the press and market commentators, and even some practitioners, to once again question the very efficacy of the approach. As I've frequently mentioned to clients, this is the third time in my 30-year career that value has been declared dead. This denigration of value is no doubt due in part to the poor relative performance over the last decade of book value as a metric for determining value. And of course, the resurgence of all things technology. As my partner Roger Debris has said, it has not been so much about value versus growth as it's been about big tech and everything else. Several highly reputed value-oriented money managers have thrown in the towel of late, and numerous others have struggled, facing large declines in assets and profitability. The performance gap between crude measurements of value and growth stocks had never been wider up until the fourth quarter of last year. But I would remind you that we've been here before, and we will no doubt be here again someday. Who can forget Warren Buffett shuttering the Buffett partnership in 1969 after an incredible 13-year run, indicating to his limited partners that he was simply out of step with market conditions, which were bereft of bargains as the one decision Nifty 50 stocks continued their upward ascent. Or Julian Robertson, the legendary manager of the Tiger Hedge Fund, folding his tent during late March of 2000, just a few weeks after the tech bubble crested, having been whipsawed by the market's volatility. Or the great international manager Jean-Marie Aveyard in 1999, who, after facing massive redemptions due to near-term performance challenges in his value funds, proclaimed that he'd rather lose half his clients than half his clients' money. We all know what happened not long thereafter to the valuations of the so-called one-decision stocks of the early 70s and the tech stocks of the late 1990s. Some would have you believe, mistakenly in our view, that today is different, claiming that the 2000 tech bubble was really just about the nascency of technology and deflating internet airballs such as pets.com or eToys. They would suggest that today's great dominant tech companies, with their seemingly unlimited growth trajectories, couldn't possibly suffer a similar fate. And they may be right. But one should not lose sight of the fact that the bursting of the 2000 tech bubble also brought down a host of great technology companies, including wonderful high-return businesses with long trajectories of expected growth, such as Microsoft, Oracle, Intel, Hewlett-Packard, IBM, and perhaps the poster child of the era, Cisco. Quite unexpectedly, the stock prices of these great, seemingly indestructible franchises in March of 2000 began to correct. By late 2001 and early 2002, these great companies had lost between 44% and as much as 80% of their value. Despite the collapse in their stock market valuations, they continued to grow their earnings. Only Microsoft, IBM, and Oracle have since been able to recoup and surpass their 1999-2000 peak stock market valuations. But it took them until October of 2016, October of 2010, and June of 2017, respectively, to do so. The rest never reclaimed their prior glory. Between March of 2000 and late 2001, shortly after becoming the largest company in the world with a market cap of $571 billion, Cisco's stock price had declined by 80%. And this is despite, in fiscal 2000, posting revenue growth of 55%, gross margins of 64%, earnings growth of 25%, and a return on equity of 14%. And the outlook for Cisco going forward remains strong. In fact, in the 21 years that followed, Cisco grew its revenues nearly threefold to $49 billion, while quadrupling its profits. And yet its stock price today, after nearly 21 years, remains roughly 36% below its peak price achieved on March 27th, 2000. Between March 9th of 2000 and October 9th of 2002, the NASDAQ index lost over 77% of its value. And it did not recoup its peak 2000 value until 15 years later in April of 2015. In our humble view, the lesson to be gleaned from the dot-com bubble and so many others, and what followed, is that price matters, even when it comes to highly innovative and disruptive technology stocks. And for those in the financial press who would question the continued efficacy of Graham's framework simply because of the poor performance of a single metric such as book value, we would remind them that while Graham paid a great deal of credence during his early career to statistically based formulations of valuations such as book value and net current asset value, his idea of intrinsic value was much broader and took into account not only past earnings and tangible asset values, but also future earnings power, conservatively estimated, and in so doing, considered qualitative as well as quantitative elements. Since we're running short on time, I cannot address all of the many lessons learned over our 100 years of value investing. Lessons about remaining humble, approaching investment with an innate sense of caution, embracing patience, thinking like an owner, avoiding the lure of market predictions, paying attention to what the insiders are doing with their own money, among a host of others. But without a doubt, the most important one To borrow from Warren Buffett's admonition to investors about America at his last annual meeting, never, and I mean never, give up on value investing. If you take anything away from today's conference, it should be the realization that price matters. Despite this difficult period for value investors, successful investment, in our view, still requires that distinctions be made between great businesses and great investments. To quote one of our earlier speakers today, the legendary Howard Marks, from his highly acclaimed book, The Most Important Thing, investment success doesn't come from buying good things, but rather from buying things well. Value investing, unfortunately, often feels incredibly uncomfortable and challenging. Buying out of favor stocks with at times low expectations and well-publicized issues, however temporary, requires fortitude and a contradictory mix of conviction and humility that's often in short supply in the investor community. It almost always requires the ability to look wrong for a while and a willingness to embrace uncertainty, price volatility, and the recognition that a fair number of those ideas are not going to make money. Behaviorally, value investing is simply harder. It should be. However, as one might expect, the vast bulk of empirical studies over the years have confirmed that value investors have been richly rewarded for suffering this hardship. As we reflect on this aging bull market and the remarkable performance to date of the FANGs and so many other profitable, and I might add, unprofitable technology stocks, we remind ourselves of the words of a supposed Eastern monarch who once charged his wise men to invent for him a sentence to be ever in view and which should be true and appropriate in all times and situations. They presented him with the words, "And this too shall pass." Are the green shoots for so-called value stocks that have been appearing of late an indication that central bankers may finally be losing control of the bond market? Will rising inflationary expectations lead to higher interest rates that prove not to be transitory and instead hazardous for the value of longer duration growth stocks? Will a vigorous vaccine-induced economic recovery supercharge the near-term earnings of so-called older economy value stocks and their non-US brethren? Will the COVID-19 virus ultimately prove to be a serendipitous top for technology stocks, at least in the near term, or instead a harbinger of a new era? We simply cannot know. We have no reason to believe we're on the precipice of a financial crisis like that which occurred in 1929. While we have no reason to believe we're on the precipice of a financial crisis like that which occurred in 1929, the observation of Ben Graham and David Dodd regarding what they described as new era thinking leading up to that stock market crash, we believe provides meaningful perspective about today's infatuation with all things technology. In the second edition of their magnus opus, Security Analysis, published in 1940, they spoke of the public acquiring, quote, a completely different attitude towards the investment merits of common stocks. The new theory, in their view, could be summed up in the sentence, quote, the value of a common stock depends entirely upon what it will earn in the future, as opposed to the dividends it pays and the asset values supporting its earnings power. Under this new theory, past earnings were only relevant to the extent they indicated what changes in earnings were likely to take place in the future, and a rising trend in earnings was all important. While Graham knew that future earnings were important, he didn't feel comfortable with the notion that the view should be entirely on future earnings. Graham and Dodd felt there were two weaknesses in this new era thinking that could lead to mischief. One was that it abolished the fundamental distinctions between investment and speculation, and two, it ignored the price of a stock in determining whether or not it was a desirable purchase. This quote from the 1940 edition of Security Analysis almost feels as relevant today, in our view, as it was then. To quote Graham and Dodd, the notion that the desirability of a common stock was entirely independent of its price seems incredibly absurd. Yet the New Era theory led directly to this thesis. If a public utility stock was trading at 35 times the maximum recorded earnings, instead of 10 times its average earnings, which was the pre-boom standard, the conclusion to be drawn was not that the stock was too high, but merely that the standard of value had been raised. Instead of judging the market price by established standards of value, the New Era based its standards of value on the market price. Hence, all upper limits disappeared, not only upon the price at which a stock could sell, but even upon the price at which it would deserve to sell. An alluring corollary of this principle was that making money in the stock market was now the easiest thing in the world. It was only necessary to buy good stocks, regardless of price, and then let nature take her upward course. The results of such a doctrine could not fail to be tragic. Later in his career, Graham expressed similar views about the market environment leading up to the 1973-74 collapse of the so-called one-decision stocks. I'd like to close my remarks with a quote from another legendary value investor, Lou Sanders, the former chairman of Sanford Bernstein, who so eloquently described, in my view, many years ago, why value investing should continue to deliver superior returns for investors. We think his words are as valid today as they were then. So let's read these. The principal dynamics in the world's capital markets revolve around a tug of war between feeling secure and making money. In the end, the feelings generally win out. A substantial amount of money can thus be made if a value investment manager is willing to spend the bulk of his or her professional life feeling depressed, isolated, and afraid, waiting for the forces of mean reversion to relieve the stress, at which point the value manager will sell and use the proceeds to rebuild anxiety. Is it worth it? This question, of course, is philosophical, but the money on the table is considerable, and the question deserves serious thought. Thank you very much for listening.